Hello everyone, you're very welcome back to the channel. Today, we're talking about what happens to your pension if you die, quit your job, or move abroad. Your pension is priority number one when it comes to long-term investing. Reason being, there are so many great benefits attached to investing in pensions. Tax relief at source, employer matching, tax-free investment growth, tax-free lump sums, and death in service benefits. Over the course of your working life, if done correctly, your pension can easily become the most valuable investment asset in your possession. However, building up your pension to become this highly valuable investment asset requires time and money. What comes out of your pension in retirement is only as good as what goes in and how early it goes in. So if you're going to spend years investing tens, if not hundreds of thousands of euros into your pension, you're going to want to know what happens to your pension if certain life events come to fruition. If you leave your job, does your pension come with you? If you move abroad, what happens to your Irish pension? If you die before retirement, will your pension be passed on to your estate? These are important questions and we're going to answer them in this video. Let's kick things off by answering the question, what happens to my pension if I die before retirement? The answer to this question depends on the pension products that you own. If you're invested in a personal retirement savings account or PRSA, a pan-European personal pension product or PEP, or any other personal pension product, then the full value of your investments within those products will be passed onto your estate in the event of death before retirement. In other words, your beneficiaries will receive the full cash value of your personal pensions if you happen to die before you reach retirement. This treatment also applies to both personal retirement bonds or PRBs and preserved benefits within an occupational pension scheme. A preserved benefit will exist where an individual was previously a member of a company's occupational pension scheme. The individual no longer works for that company. The individual worked for the company for a minimum period of 2 years, and the individual didn't take any of the other pension options that are available when leaving employment. If that's the case, then the full value of the preserved benefit will be paid to the individual's estate in the event of death before retirement. Things become more complicated when an individual dies in service of their current employer and they're a member of the employer's occupational pension scheme. Revenue rules state that where an employee dies in service before normal retirement age, the maximum benefits that can be provided from an occupational pension scheme are as follows. Firstly, a death in service lump sum can be provided which can equal the higher of two amounts. A, 4 times the individual's final salary at the date of death minus any other lump sum death benefits received from other company pension schemes or PRBs, and B, 2 times the individual's final salary at the date of death. This is a cash lump sum which is made from the individual's company pension fund to the individual's estate. Secondly, a refund of the employee's own contributions to the occupational pension scheme with or without interest may be paid in addition to any death in service lump sum payment. The wording of this sentence raises a question about the exact value of any refund of employee contributions. The reference to with or without interest suggests that in certain circumstances, only the par value of the contributions may be refunded to the estate as opposed to their current market value. McMahon Legal suggests that for additional voluntary contributions or AVCs made to an occupational scheme, the full market value of the AVCs may be available as a refund to the estate. For non-AVCs, i.e. normal employee contributions, the par value plus a reasonable amount of interest may be available as a refund. By looking at a pre-retirement debt claim form from Irish Life, we can see that the value of any employee contributions or additional voluntary contributions are available as a maximum benefit, which, if taken to mean market value, could suggest that it is possible to receive a cash lump sum equal to the current market value of the employee's total contributions. However, because of the ambiguity which exists, it is wise to inquire into the terms and conditions of your own occupational pension scheme to see how payouts will be managed in the event of a death before retirement. Simply ask whether the full market value of employee contributions plus AVCs will be paid out to your estate in addition to the death in service lump sum, or if the refund of contributions will be at a lesser amount than fair market value. Finally, if after the payment of the death in service lump sum and the refund of employee contributions, there is still a remaining balance in the individual's name, that remaining balance must be used to either A, purchase an annuity for life for the benefit of the spouse, civil partner, or dependents of the deceased, or B, transfer it to an approved retirement fund or ARF for the benefit of the spouse, civil partner, or dependents of the deceased. Dependents are defined as being a spouse, a civil partner, a child under the age of 18, a child under the age of 21 who is still receiving full-time education or vocational training, or any other person who is financially dependent on the deceased individual. The first point to note here is that it's very important that you register who your dependents are with the trustees or administrator of your company's occupational pension scheme. That way, there will be no confusion around the payment of benefits in the event of a death in service. Send an email to the relevant person in your company to get this done. Secondly, there is a question around what happens to the unpaid balance, if any, if the deceased individual does not have a spouse or any dependents. There is no specific guidance which answers this question, as revenue solely deals with payments made for the benefit of spouses, civil partners, and dependents. However, McMahon Legal notes that there may be a provision for a member's nomination of survivor's benefits. The beneficiary of the benefits on death may be nominated by the member in his lifetime. This may be legally binding. Therefore, it's worthwhile having a conversation with the trustees or administrator of your occupational pension scheme about nominating beneficiaries outside of a spouse or a dependent to receive some or all of the death and service benefits associated with your occupational pension. Next, let's look at the question, what happens to my pension if I die after retirement? The answer to this question depends on whether your pension is used to purchase an annuity or if your pension is transferred to an approved retirement fund or ARF. If your pension is used to purchase an annuity, what happens to that annuity upon death will depend on the type of annuity that is purchased. An annuity is a guaranteed income stream for life that's provided in return for some or all of the value of your pension. Annuities can be either single life or joint life annuities. Single life annuities die with the annuitant. In other words, when the single life annuity holder dies, so too does the annuity payment. Most single life annuities come with a minimum payment period, usually 5 or 10 years in duration, whereby if the annuitant dies within the minimum payment period, the single life annuity will continue to provide an annual income to the deceased individual's estate until the minimum payment period lapses. It's very important that you understand the implications of single life annuities. The full value of your pension, say €1 million, could be used to purchase a guaranteed income for life of €50,000 with a minimum payment period of 10 years. If you were to die within 10 years, your estate would effectively suffer a capital loss of €500,000. This isn't necessarily a problem if you don't want to bequeath your pension to anyone, or if you want the certainty provided by an annuity, but it is something to consider for those who wish to leave a capital sum to their beneficiaries upon death. Joint life annuities, on the other hand, allow for a percentage of the annual annuity income to pass onto a surviving spouse upon death, i.e. 50%. However, once again, the estate will almost definitely suffer a capital loss when the main annuitant dies. Additional features such as overlap and inflation protection can be added to annuities to increase their flexibility. However, the more flexibility you add, the worse your annuity rate will be. A low annuity rate will equal a low annual income in retirement. Irish Life has a nice summary table which outlines the implications upon death for different types of annuities. With ARFs, on the other hand, because your pension is being invested as opposed to being used to purchase an insurance contract, when you die, the full value of your fund will remain within your estate. This means that your pension can pass on to your spouse, children, or whoever else you deem fit to receive it. If you want to learn more about annuities and ARFs and which is best for retirement, check out the video popping up on screen now. Finally, let's look at the question, what happens to my pension if I quit or move abroad? The reason why we're addressing both of these scenarios together is because they both relate to the same thing, a pension transfer. Yes, it is possible to transfer one pension to another pension. This process is oftentimes referred to as pension consolidation, and it's more relevant now than ever before. You see, before the pandemic, it was commonly accepted that the younger members of the current workforce are less likely to stick with one employer for life as compared to older generations. Whatever amount of truth existed in that statement has certainly been amplified in the post-pandemic era of remote working and the Great Resignation. Multiple jobs likely equals multiple pensions, and not just in one country. It's well within the realms of possibility that a single worker could have multiple pension entitlements across different countries. The transferability of your pension depends on both the pension product that you're transferring and the pension product that you're transferring to. Irish Life has a pension transfer matrix which provides a helpful summation of what is and isn't possible. Let's deal with non-overseas transfers first. A PRB can be transferred to another PRB or a company pension, but can't be transferred to a PRSA or a personal pension. A PRSA can be transferred to another PRSA or a company pension, but can't be transferred to a PRB or a personal pension. A personal pension can be transferred to another personal pension or a PRSA, but can't be transferred to a PRB or a company pension. Note that because a personal pension can be transferred to a PRSA, it's possible to first transfer the personal pension to a PRSA and then transfer the PRSA to a company pension. A company pension can be transferred to a PRB, a PRSA, or another company pension, but it can't be transferred to a personal pension. Prior to Finance Act 2021, a transfer to a PRSA from a company pension was only possible if the individual had been a member of the company pension scheme for less than 15 years. Finance Act 2021 removed this requirement. Irish Life's pension transfer matrix is an outdated document which doesn't reflect this change, hence why there's a footnote explaining that certain restrictions apply. Revenue's guidance on transfer payments in Chapter 13 of the Pensions Manual confirms the transferability of company pensions to PRSAs. In relation to pan-European personal pension products, Chapter 31 of the Pensions Manual confirms that transfers from a PEP to other personal pension products or to an occupational pension scheme is not permitted. Transfers from other personal pension products or an occupational pension scheme to a PEP are also prohibited. In effect, this means that PEPs are pension products for life, which are fully portable throughout the EU. Now let's move on to overseas transfers. Company pensions and PRSAs can be transferred to an overseas pension provided certain conditions are met. Note that a PRB can transfer to the UK but not to any other country provided these conditions are met. Firstly, a transfer must be requested and a revenue overseas transfer declaration must be completed. Secondly, the overseas arrangement must provide relevant benefits, the definition of which is on screen. And finally, the overseas arrangement must be approved by the appropriate regulatory authority in the country concerned. Note that it's the responsibility of both company pension trustees and PRSA providers to satisfy themselves that the conditions for transfer have been met. For transfers to the EU, the overseas scheme must be operated or managed by an institution for occupational retirement provision, or ARFs. It must be established in a member state of the EU, and the scheme administrator must be resident in an EU member state. Revenue guidance notes that transfers to the UK should be dealt with on the same basis as transfers to EU member states. For transfers outside of the EU, a transfer can only be made to a country in which the member is currently employed. As for overseas pension arrangements transferring into Ireland, this will be allowed where the overseas pension scheme facilitates the transfer, the relevant regulatory authority in the transferring country approves the transfer, and the individual is an Irish tax resident. For UK transfers, the situation is quite different. The UK tax authorities require that non-UK pensions which receive UK transfers are registered with them as a qualified recognised overseas pension scheme, or QORPs. The HMRC website contains a list of Irish pension schemes which are registered as QORPs and thus can accept UK pension transfers. It is worthwhile mentioning that while pensions can be transferred and consolidated, that's not to say that it's the right thing to do. Remember, for occupational pension schemes, provided you worked with the employer for at least 2 years, you can elect to retain a preserved benefit within the company scheme. Deciding whether or not to consolidate 2 or more pensions requires you to consider factors such as any special benefits attached to a given pension, which you might lose on consolidation, the age at which you can access pension benefits, the investment selection available, fees and charges, and much more. Because there is a high degree of variability between pensions, the decision to consolidate is one that should be made in the company of a financial advisor if you don't feel capable of making the decision yourself. So that's what happens to your pension if you die, quit your job, or move abroad. If you have any questions on any of the material that was covered in this video, please don't hesitate to leave it as a comment down below and I'll answer it. If you found this video to be useful, can I ask that you take just 2 seconds out of your day to show your support by leaving a like on the video, subscribing to the channel, and sharing the video with family and friends. Before you go, you might be interested in this next video, which talks about Ireland's dire state pension situation. Thanks very much for watching, and I'll see you soon.